Breaking news, the markets just opened in the United States, and it was brutal, frankly. You can see all yesterday's gains basically wiped out. This is after a new private report on layoffs, recession-level jobs cuts, this report says, and that's on top of the wild uncertainty on tariffs. So let's get right to CNN's.
The U.S. economy just survived 2025. That's actually the headline. Not thrived, not bounced back, survived. And honestly, when you look at what 2025 threw at it, surviving is genuinely impressive. Trade wars, the longest government shutdown in U.S. history. A data blackout so severe that economists literally couldn't get official numbers for weeks. And yet, here we are. GDP is still growing, unemployment hasn't blown out, and the stock market is sitting near all-time highs.
Americans are not feeling any better about the overall economy.
The U.S. labor market is not as strong as it has appeared to be.
How's the Fed going to communicate that it's staring at stagflation?
Now, I really want you to hold that image in your head. Economy surviving, markets near highs, because I'm about to show you the photo that's hidden just behind it. Car repossessions are rising. Credit card delinquencies are climbing. Recent college graduates are having the hardest time finding jobs since the aftermath of the 2008 Great Recession. The black unemployment rate jumped to 8.3%, double the rate for white workers, a number economists say would dominate every front page in the country if it applied to the general population. So is a recession coming in 2026? Depends entirely on which America you're living in. The load-bearing wall, and the crack nobody wants to talk about. An economist named David Schneider put the whole situation into one sentence. The economy is literally moving at two speeds, with businesses and affluent households stimulating growth, fueled by AI spending and record asset prices, while the average person is increasingly anxious and financially exhausted. David Schneider, certified financial planner. On one side, wealthy households and major corporations, flush with AI-driven stock gains, spending freely, pushing GDP numbers up. On the other side, pandemic-era savings basically gone, people falling behind on car loans and credit cards, and wage growth for the lowest earners barely keeping pace with a grocery bill. And here's the part that should genuinely unsettle you. The entire economy right now is being held together by one thing: AI. If it weren't for the AI spending boom, we would be in a different place right now. Michael Strain, American Enterprise Institute. That's not a prediction. That's an economist describing 2025 in hindsight.
The American job market is flashing blood-red warning signs. Beneath the political turmoil there, a terrifying wave of job cuts accelerating, shattering financial stability, the U.S. dollar sinking, recession fears gripping the economy.
Unemployment, prices, and the risk of a U.S. recession is rising. A financial storm facing the world's biggest central bank, with tariff uncertainty making bosses reluctant to hire.
The surge in data center construction, the AI-driven stock market rally, the capital expenditure explosion from major tech firms, that is what offset the drag from trade wars, tariffs, and a cooling labor market. Which raises a very uncomfortable question. What happens if the AI boom cools down? The biggest tech firms in the world are spending astronomical sums on AI infrastructure. The question that keeps serious investors up at night is when those investments need to actually pay off. Because if AI productivity gains don't materialize quickly enough, the valuation correction will be fast and brutal. One financial planner called this a reverse wealth effect, a bursting AI bubble that evaporates the paper wealth currently propping up high-end consumption. And since high-end consumption is one of the only things keeping overall spending numbers positive right now, that domino fall matters for everyone, not just the people holding tech stocks. The thing saving the economy and the thing most likely to break it are the same thing. That's where we're starting 2026. 3 more risks that could finish the job. The AI question is the biggest wild card, but it's not the only one. Here are 3 more threats economists are actively tracking. Risk number 1, the tariff hangover. Tariffs didn't cause the runaway inflation crisis everyone predicted in 2025. Partly because companies ate the cost rather than fully passing it on to consumers. But that buffer doesn't last forever. If reshoring production costs keep rising and companies finally decide to pass them on in 2026, the Fed faces a nightmare. Inflation reaccelerates just as the job market is already cooling. That means no rate cuts, which means no relief for the people who desperately need it. And on top of that, Trump just nominated Kevin Warsh to lead the Fed when Powell's term expires in May 2026, adding a fresh layer of uncertainty for anyone trying to predict monetary policy this year. Risk number 2, stagflation light. Hot take alert, but stagflation light might be the most accurate description of where the U.S. is right now. Core inflation is sitting at 2.8%, still above the Fed's 2% target, and it actually moved further away from that target recently, not closer. Growth is positive but slowing. The labor market is softening. This is not a healthy economy at full stride. This is a tired economy trying to look normal on a treadmill it can barely keep up with. Risk number 3, the consumer breaking point. The American consumer powered the entire post-pandemic recovery. Spent through inflation, spent through rate hikes, spent through every economic warning sign for 3 straight years. But that run is ending. Pandemic savings are gone. Credit card delinquencies are rising. Car repossessions are picking up. Economists are now watching for what one financial planner called a consumer breaking point. The moment households exhausted by high inflation and record debt simply stop spending. When that happens, and it's a when, not an if, it doesn't just hurt retailers. It hits the entire economy because consumer spending makes up roughly 70% of U.S. GDP. What to actually do about it? Stop trying to predict the recession. The experts can't reliably do it. The New York Fed's own model puts the probability at 20.4% by year-end, a number that will shift every single month. Making major financial decisions based on that kind of probabilistic noise will make you miserable and probably poorer. What you can do is prepare for volatility without overhauling everything. Check your cash reserves, not to time the market, but to give yourself liquidity if something goes wrong, and, more usefully, to have dry powder to buy when everyone else is panicking. Because here's the data point that gets buried every time recession talk starts, plus 20%. Average S&P 500 gain in the 12 months following the end of a recession since 1948. The market also averaged a 3.5% gain during recessions themselves. The stock market drops before a recession starts, often months before, and it begins recovering well before the recession officially ends. Sitting on the sidelines waiting for clear skies means you miss the biggest gains, which almost always happen when the economic news is still the worst it has ever been. For investors who stayed fully invested through both 2008 and 2020, there's an interesting data point. Walmart, Netflix, and T-Mobile all beat the S&P 500 in both recessions. Boring, unglamorous defensive businesses that people cannot stop using no matter what the economy does. That's the playbook. Utility stocks, healthcare stocks, and consumer staples tend to outperform during downturns for the same reason. Their earnings are insulated from economic mood swings. You can rebalance toward them now by trimming the parts of your portfolio that have had the most spectacular AI-driven run-up, while those valuations are still rich. The question nobody in Washington is actually answering. Here's what gets lost in the recession probability models and the GDP forecasts. For a very large number of Americans, the recession is already here. Not in the technical definition, but in the lived reality of a college graduate who can't land a job in an industry that was scooping up their peers just 24 months ago. In the reality of a family where homeownership is still completely out of reach, childcare is still broadly unaffordable, and healthcare premiums are about to rise for millions when insurance subsidies expire. These aren't new problems. They're the exact problems that drove voters in 2024, and not one of them has materially improved. You can't tell people what their reality is. Heather Bauschy, former White House economic advisor. That's the sentence the Biden administration learned the hard way. And it's the sentence the Fed should probably tattoo somewhere visible before their next policy meeting. Because here's the structural problem heading into 2026. The institutions designed to respond to economic distress are still calibrated for a different kind of problem. The Fed can cut rates to stimulate hiring, but rate cuts don't fix unaffordable housing. They don't rebuild a depleted savings account. And with the new Fed chair incoming and inflation still above target, even that tool is currently off the table. The outcome for 2026 depends on one question. Can top-heavy spending from wealthy households and AI-fueled corporations continue to carry the weight of an increasingly exhausted majority long enough for the bottom half to actually recover? Nobody has a clean answer to that. The New York Fed puts recession odds at 20.4% by December 2026. One analyst's more unsettling scenario isn't recession. It's a market melt-up of 25% or more, driven by AI euphoria, followed by exactly the kind of correction that wipes out the paper wealth propping everything up. The soft landing and the hard crash are both on the table. Prepare for both. There's a specific group of workers sitting directly at the intersection of all these pressures right now, and it's not the group most people are talking about. That's the next video. Subscribe so you don't miss it. And keep learning.